2012 was actually the beginning of what I'd say is a nascent recovery for housing. We saw for the first time since the financial crisis an upward movement, about 4% rise in home prices nationally, which is a good sign. That does not mean, however, that we're by any means over the slump that we've seen over the last 5 years in housing. Another sign of good performance is that mortgage rates are still, below 4%, which is a great deal for people that are out there trying to get into a home, try to refinance their home. So from the standpoint of affordability, from the standpoint of rising home prices, the signs look pretty good for the coming year, as a matter of fact. So looking into 2013 for people that are potentially on the market to buy either their first home, so first-time home buyers, repeat home buyers, those folks will find, or even people that are looking to refinance their home, again, they're going to find that interest rates are as good as they're going to be. Below 4%, the Federal Reserve recently has even committed further to 2013 in keeping interest rates low through their mortgage-backed securities and treasury purchases. And so we would expect that will continue to be the case at least over the next 12 months. So that's a really good thing. The other thing that's happening is that housing inventories are starting to decline a bit, which is a good sign. We've had since the crisis this problem with a large number of homes on the marketplace. We've had historically high vacancy rates for single-family properties, as high as 3%, when 1.5% is usually what we see, so double the average. We're seeing those starting to abate a bit. We're also starting to see that the underbuilding that happened over the course of 2012 with home builders has helped to stop adding inventory to the supply of housing, which is good. So bringing demand and supply closer together means that for those that are looking to buy a home that's probably available, I think people are looking to sell their home. It's another good sign that's out there because it will help bring equilibrium back into the marketplace. So for home buyers, beyond the fact that interest rates are really good, one of the things that they need to keep an eye on in the coming year is the availability of credit, that is being able to get a loan. We know that since the crisis, lending has been very tight at most, if not all, of our major banks, and as they try to get through their own problems. And it will remain somewhat tight heading into 2013 for a few different reasons. I think that if people have good credit histories, that is strong credit scores, they show how they're being able to manage their credit effectively, that they bring at least 10-20% to the table, and that they have good stable income and employment, they won't have a problem getting a loan. Where I think we're going to have some struggle is with perhaps the first-time home buyers. FHA right now, which has tended to be a good source of funding for first-time home buyers, is itself experiencing a problem for the first time in its 80-some-year history, in that its actuary fund, its insurance fund, is underwater now. And so one of the things they may be doing in 2013 is increasing the fees that they charge to borrowers and or increasing lending standards, which could make it a little harder to get a loan if you're a first-time home buyer, but chances are you'll probably no worse than what we saw in 2012. So yeah, so the wild card for housing in 2013 really happens to be around what happens with the fiscal cliff. There's been some discussion of late of trading off things, revenues for costs and whatnot associated with our fiscal problems. And one of the big ticket items that has historically been a sacred cow in the mortgage industry has been the mortgage interest deduction. If we see that traded, I think it's worth about $100 billion in revenue each year. That could have a material impact, negative impact on the market in 2013. Likewise, the Mortgage Debt Relief Act of 2007 is expiring. And as a result of that facilitated folks in moving to short sales, which has been a way to try to remove some of the problems out of the foreclosure markets. If we see that not be reinstated, that could also be a sign of weakness for the market from an inventory standpoint next year. Overall, my expectation is that there will be some agreement that will come about. We will not go over the cliff. If we do, it will be very, very difficult, not just for housing, but for the general economy as a whole. And looking into next year, I think the more important thing is the likelihood for further improvement in unemployment rates and improvement in the overall general economy. I would expect that we will be moving along very sluggishly. I think what that means in general, looking kind of at on a large scale for housing, is that steady as she goes, we'll see slight improvement from where we were in 2012, but no real serious improvement from beyond that.